And one of the ways that you can have more tools in your tool belt is to have knowledge about programs that can help your clients. So, which is why I wanted to bring Kevin into this call and have him spend a few minutes. And I'll share a link while Kevin's talking to a video that Kevin and I did last week, just explaining a one buy down. And we kind of started talking the strategy a couple weeks ago when I said, well, if a buyer can pay for their own rate buy down, which Kevin, am I correct in saying not every mortgage company allows this?
That is correct.
But some mortgage companies like Kevin's allow the buyer to self-fund a 2-1 buy down. And when we ran the scenario favored, instead of putting 10% down, for instance, putting 5% down and self-funding a rate buy down. Kevin, you want to share a little bit of the thoughts on that? And they can watch the full video later. But when when an agent is up against a buyer that's just like, you know what, I see houses I like, I just do not like the payment. How can this help them?
Sure. So, a lot of my first-time home buyers put 10% down. So I looked at a $600,000 purchase, and uh, 10% down, that's $60,000 out of pocket, and a pretty high mortgage payment. Now, what I looked at is if we move them to 5% down, the down payment goes down by 30,000, which is great, but because of the higher loan amount and a slightly higher interest rate, the payment actually goes up by $250 a month. So that's not great. And that's part of the reason why a lot of my borrowers shift from 5% down to 10% down. So then Tracy and I said, well, what if they do 5% down but self-fund what's called a 2-1 buy down? So in this case, the borrower can self-fund, pay a little over 2% of the loan amount to secure 2 years of interest rate savings. So in year one, the payment goes down by 2 percentage points, and they save about $450 a month compared to the 10% down scenario. And then in year two, they save over $100 a month compared to 10% down. And then they go back to their regular payments by year three. Hopefully, they will have refinanced by then. But the other significant thing about doing the buy down with 5% down is they've saved about $17,000 out of pocket. So they're putting 30,000 down and they're paying about 13,000 for the buy down. So they're at about $43,000 total cost. Compared to 10% down, they're saving quite a bit of money.
And
Uh,
and this is hopefully you guys can see this now. I pulled up the spreadsheet that Kevin and I talked about on that video that we did, which I just put in the chat link if you want to watch the video yourself, which I recommend because it'll give you the knowledge you need to talk to clients about this. And obviously, you're not meant to you don't need to be an expert on it. Just talk enough about it that you can make the connection to someone like Kevin. And I'll have Kevin share his information too, so you can touch base with him if you want to have a client talk to him about this. But this is a big deal. This 3,400 versus 3,000 a month. They wouldn't have achieved that with the 10% down. It's actually over the 5% down program. It's $700 difference. But instead of putting 10% down, if they put 10% down, it's $3,400 payment. If it's the buy down, it's 3,000. That's a $460 a month difference in year one, which is big for people. A lot of people have they're not having necessarily price intolerance, they're having payment intolerance. Like I don't I don't mind the price. What I mind is the monthly payment. So this is a perfect strategy for them. And one of the points that I want you guys to know is this can be if you're in a competitive bidding situation, it's probably better to approach this as a buyer paid rate buy down, but you can get a seller concession that you can use part of towards this rate buy down as well. It's just you use your regular seller concession language, seller to contribute $7,000 towards buyer's closing costs, prepaids and escrows. And in this scenario, if it's roughly $13,000 to get this rate buy down instead of the buyer paying that and their closing costs. You could get a seller concession for 7,000, 8,000, 10,000. You don't have to ask for the whole thing, because that gets a little bit uncompetitive if you're saying I need $13,000 seller closing cost credit on this because you want the seller to fund the buy down. It gets a little bit uncompetitive. But in certain scenarios, in certain markets in the state or in New England, you may have an opportunity to get some seller concession if your net offer is the best offer. Any other thoughts you want to add on to that, Kevin? And before anybody can ask questions about the general idea of this?
Yeah, sure. Just two quick ones. You can just to emphasize what you were just talking about. You can split the cost of the buy down with us between buyer and seller. And secondly, if the buyer gets the buy down and then say refinances in 6 months, they get a refund of all of the unused buy down money. So it comes back to them on the back end. So there's really no way to lose their upfront investment on this.
Totally, totally. And
Kevin,
it
I have a question as far as let's say that we determine that this is the perfect opportunity to assist a buyer and the language that we would put in the offer. And as Tracy said, if we're asking for a contribution from the seller, it would be for closing costs, allowable prepaid items. And would we want to add mortgage discount points? Because is that what we're talking about as far as discounting? Is that appropriate language or not?
So it is, but this technically doesn't fall under discount points. And it shows up differently on the closing disclosure. It's best captured just generally as closing costs.
Okay. And you would not need to stipulate that and add to that cost of buy down any
Not to
kind
my
of language.
knowledge.
Okay.
Yep.
Very good. Thank you.
We did have one question that if if the net exceeds the appraised value, what happens? Um, I'm not sure. I guess like the basic, I guess my understanding of the question would be, if it doesn't appraise. My, my,
Oh, okay.
my first comment on that is I'm not seeing or hearing many properties not appraising. We were all worried about this when the market was really moving quickly and everything was 25,000 to 50,000 over whatever the last sold was. And then that fear wasn't realized because the appraisers, in my opinion, from everything I know about appraisers, is they're not there to stop markets from appreciating. They're there to protect the mortgage company from being too much at risk. And they've all somehow or other in my opinion, gotten a little message behind the scenes like, don't kill loans. Just make sure we're not overextending ourselves at a ridiculous level, right?
Yeah, and Tracy, can I add one more thing to that?
Yeah, yeah.
There's another dynamic to it. When when a property doesn't appraise, most of my borrowers, and I work with them, we will go back with a written rebuttal to the appraisal company. And there's a formal process to that. The appraiser has to consider any new information or the fact that we pointed out errors in their original appraisal. They have to respond to us in writing, and sometimes they'll actually change the appraisal. But here's the key point: they don't get paid for that extra work. So, in my experience, if appraisers can make it work and cover themselves on the liability side, they're going to make it work because, I mean, frankly, no one wants to work for free.
True, true. And there's probably at some level some fear if I come in too low that maybe I won't get future business. But I mean, I know most of the appraisals go through the automated appraisal system now, so that's probably not a true reality, but it's a behind the scenes fear of being blackballed from future orders.
Yeah, we don't because of the new laws that
Yeah.
under Dodd-Frank that came into effect, we can't even come close to doing that. Otherwise, I'll be dressed in pinstripes.
Yeah. But I think the fear still exists. Like you don't,
Yeah,
I don't know of any appraisers. I'm like, crap, this appraiser's coming back on another deal. They're gonna come in low.
yeah,
Um, they all seem to kind of realize that their job is not killing deals. It's
right,
it's protecting the bank's interests to make sure that the lower of the two, the purchase price or appraisal, is what they're giving a loan to value based on the loan 5% down, 3% down, 10% down, whatever it is. They're basically ensuring the bank isn't giving a 95% down loan on a property that doesn't have the value there, so that if they ever had to foreclose, they would be SOL. I mean, that's the reality of it. They don't want to be in an SOL position. Um, so yeah, hopefully that answered that question. Any other questions on the buy down? It's pretty simple to kind of open the door to that. Just say, hey, I know you're not happy with here's a scenario where I see this working a lot. You've got a buyer that's looking up to let's say 700,000. And the houses that they really like are like selling for 750. They could get a loan to 750, but they don't like the mortgage payment on that. But they keep losing out. They see a $700,000 listing home come on. They love the house. They go see it, 10 offers. They go to 710 and stop because they just don't like the payment. Well, let's have a conversation about how maybe a rate buy down can help you get that house, get the payment that you want now, and give you time to catch up to the tax savings and hopefully a refinance opportunity.
Tracy, I have a question for Kevin, and I'm just trying to think of putting it in practical terms, explaining such a thing to the buyer. And based on the example that you have on screen, that additional, what amount of extra buying power does that afford the buyer? I mean, obviously, we don't want to position ourselves by giving information to a buyer and say, now you can afford so much more. But what if you're saving $400 a month, what dollar amount might that represent as far as additional purchase price?
That's a great question. And unfortunately, when we are underwriting and calculating how much your maximum loan amount that you get approved for, we have to base it on the year three interest rate, the high interest rate. So in reality, you don't pick up any additional buying power.
Good. That's good because obviously we want to be very careful not to present something in such a way as to maybe misrepresent it.
Kevin, how oftentimes do people buy at their very max limit?
So up until 3 years ago, not very often. And I would say among first-time home buyers, it's more than 50% now
Yeah,
because they're really hoping that rates will come down in the future.
right. So that tells me people always have a reluctance to spending as much as they can. I think lenders have really pushed the limits on the DTI ratios to where it's not highly comfortable at that max. It's
Right,
for most people, it's not. And I think there, as many people that aren't closing now, there's probably a large portion of people that have a pre-approval in hand, know what the monthly payment would be on that max pre-approval, and are just maybe not even actively really looking in the market because they're not comfortable at that level. And they know that from what they're seeing on the market that they'd have to spend that to get what they want. So this is an opportunity to kind of give them a different spin on it. Like, if you're not one of those 50% that's comfortable being at your absolute max on a monthly basis, maybe the buy down's an option for you to where you can get the more comfortable payment. I've had conversations with buyers about the tax benefits. I try to keep it in very simple form and not mention, basically say I'm not a tax accountant, but in simple math, if you're paying a $3,000 a month payment in the first year, it's mostly interest. Call it $30,000 in interest in that first year. If you're a 25% tax bracket, um, person in this world, then that's saving you $8,000 on your taxes at the 25% tax bracket. That's money that you're going to see. And a comment I sometimes get is, I still got to make the monthly payment until I get that tax refund next year. Well, this is a way for that to catch up. You get the lower payment, and then you get that extra, and not to mention that if you're doing a buy down, the buy down is tax deductible as well.
Yeah,
So
as long as the buyer pays for it. Yes.
yes, if you're the buyer and you're paying the $13,000 to get that buy down, that's tax deductible as well. So that, let's say that was 8,000 in tax benefits from just the interest, and then you add another 25% of the 13 grand, that's another 4 grand. That's a potential for $12,000 or more back in your tax refund next year. That'll allow you to be more comfortable with that 1% lower program in year two, because the second year will be 1% lower. So on today's terms, it would be, 5.64 in the second year and then 6.64 in year three. You're giving your buyer time to catch up, because a lot of buyers, they get a little bit of a bump in their pay every year if they're good at what they do. You're giving them the tax benefits and hopefully a refinance opportunity in the next couple of years. Does that make sense? So this may, in some cases, make them want to pay a little bit more. If you're going into a competitive situation, you're like, I'm just talking to the listing agent. I think that from what I hear, there's many offers coming in. We're probably going to be up over 10 offers. And there's kind of like their pre-approvals to 750 and they're kind of stuck at 710. Have this conversation with them. Like, if you really love this house, maybe this is one of the strategies we think about using. And you'll be able to go to your max limit and still have the comfortable payment for a couple years, for the tax benefits to catch up, for the refinance opportunity, and then you'll at least have the house you want. So great strategy. You got to keep it in your tool belt, bring it out when it makes sense. But I think it's a great strategy. Any other questions on that? Because I did want Kevin to talk about the buyer program a little bit too.
Yes, good morning, Evan. My question borders on what if the buyer has like a lower um, credit score, like say 660? Would all this be, possible?
Um,
Or or is there gonna be like a little bit difference in the numbers?
that's a great question. So if they qualify for conventional financing, then yes, you're going to get the same rate differential, 2% savings in year one and 1% in year two. If, however, the credit score is so low that we have to shift from what's called a conforming loan over to FHA, FHA is a little stricter with the buy down program, and they only allow the seller to finance it. So the buyer can't self-finance it. So good question.
But it's a good question too, because I hadn't thought about that scenario. But if you have a buyer that doesn't have premium credit and their rate is come in a little higher, then this could be a strategy for that client that's been working on their credit for a while and delaying home ownership because of that, and it's just not quite where they'd love it to be to get them exactly what they want for a rate. Use this, you
Yeah.
know, the because the fear of waiting is the rates go down and the prices go up. It's like, okay, a 1% decrease in rates matched with a $50,000 increase in purchase price, and you're probably at the same payment.
Yeah, and Tracy, good point. If we have a buyer who has a low credit score but a path to a higher credit score. And by path, meaning, I've got to pay down some credit cards. I have a bonus coming up in 6 months, and then I'm going to be able to do things with my credit. I'm working out some collection items. Those things take months. So if you want to buy now and fix your credit score later, the buy down would be the bridge to help with that payment shock. And then again, hopefully you refinance when, maybe 4 or 5, 6 months down the road when your credit score is higher. And again, you get a refund of the unused buy down funds.
Yeah, totally. Any other questions before we move on to the next strategy? All right.
Yes, you said they get a refund of
Yes.
their buy down funds. Is that going to be like will that be up to 100% or full amount or not?
It's 100% of what's not used. So you start using it on your first payment, and then that gets subtracted from the upfront 13,000. Whatever is unused, there's no penalty.
Okay.
Yeah, so they can
Right.
apply that to principal, right?
Yeah, we apply it to the principal when you refinance. So if you haven't used, in this scenario, say $8,000 in funds, your principal balance when refinancing gets reduced by $8,000, dollar for dollar.
Right. Thank you so much. Because the reason I was asking this is that I do have a client right now, and these options were actually, like, presented to my clients. So, they were actually looking at it to see if it would be possible for them to actually do that, based on their funds. So, thank you so much.
Sure thing.
Yeah. So if and this that was a good question because if let's say in 4 months all of a sudden the rates drop into the fives, they can there's it's they can refinance and let's say they've only used 2,000 of that buy down. So up to that point, the rest gets refunded back to them. So there's no real loss of doing this. You're basically just, by buying the lower interest rate, you're, obviously the lower the interest rate, the lower the interest, and therefore you're saving yourself money by doing so. That's why the scenario is, it's a smarter decision to put, if you got a 10% down buyer, hey, let's talk to Kevin about using, instead of doing 10% down, do 5% down with a buy down, and it's going to be a better scenario for you. It's going to save you money. It's going to give you more tax benefits, and it'll give you a net lower payment right away. So definitely worth considering. And if you've got a buyer that's doesn't understand it, because it's not the easiest thing to understand. The scenario I might do is a lot of times, whether I mean, I'm comfortable doing it. Some agents would just lean on the loan officer for this. Is like, hey, we're getting ready to make an offer, Kevin. Um, this is probably where we're going to need to go. Can you run a scenario for the payment using just, um, with no buy down versus with buy down, so I can show them the monthly payment? Because a lot of clients before they're making their offer, are like, well, what's the payment going to be on that? What's the payment going to be on that? If I go another 20,000, what's the payment going to be on that? That's what most people translate to. What is the monthly payment going to be? Not all this, okay, I've got to understand how to buy down works, what today's rate is, running a calculator on what it would be if it drops 2%. Like, give them the bottom line. If we do this, it's this. If we do that, it's this. And give them a few scenarios to make them feel comfortable understanding what this would mean to them. Does that make sense?
Yes. Please, could you leave your contact, in the chat, Evan?
Sure.
Yeah, Kevin, I'll add that in while we jump on to
Okay.
the next one.
Thank you.
So So let's talk about the cash buyer program. How Kevin, explain how MEP can give buyers an upper hand in guaranteeing the seller a closing using
Yes.
the cash buyer program.
Okay. So let's say we have a buyer that wants to present a cash offer. So, and this is the real simple scenario. They don't have to sell anything. They've got the money in the bank. So the way we do it is we partner with a finance company. We pre-underwrite them. So, we can write a commitment letter for them. We do a little valuation work on their offer and the property that they're making an offer on. And when they submit their offer, they're submitting it as a cash offer along with us. And we say that with 100% certainty, we will buy the house if the borrower, for whatever reason, can't. And we've already underwritten the borrower. So that's how we do it. And we charge the borrower a fixed fee at closing of $499. That's it. There's no intent for us with our finance partner to take ownership. So the business model is charge a fee for taking that added risk. And most of the time, maybe 800 out of 801 times, we're not taking possession. We don't want to do it, and that's not part of the game. The second scenario is a little more complicated. So we have a second product if you do have a current home to be sold. So with this second product, we come up with a cash offer for the current home. Okay? Not the home they're buying, but the current home. And we come up with an unconditional cash offer for the current home. What that does is it enables the buyer to waive their home sale contingency. And when we underwrite them for the new loan, we can ignore their current payments. So we're exploiting something in existing guidelines. So at a minimum, we can waive the sale contingency and give the buyer 6 months to sell their home. Again, we do this for a fixed fee, $999. Now, we can combine this product with the first one, the cash buyer, the cash offer program, to make the buyer who has to sell a current home also a cash buyer. We may have to kind of bring in a bridge loan, which is often a home equity line of credit on their current home. And again, we're going to do that behind the scenes with our finance partner. So that's it. There are a lot of underlying details to it, but I'll leave it at that for now and open it up to questions.
So a buyer wants to, let's say you have a buyer, you keep losing out to cash offers, and they say,
Yep.
okay, Kevin, we want to explore this.
Right.
What are the steps?
Good question. So then we collect all of the borrower's income docs, tax returns, pay stubs. We verify their employment. We put it through underwriting.
Yeah.
So we're able to write a commitment letter at that point. And then we do some valuation work. So at the time that the buyer is ready to make an offer, they have to give us the address, the property, and what they're offering, because there's some appraisal risk here. So we do some valuation work behind the scenes. It's called a desk review. So we're not sending out an appraiser. We want to turn around our cash offer within an hour or 2 hours, if possible. In rare cases, it might take a day or two, but we want to do it immediately because we know that the market moves quickly. So then once the valuation work comes back, then we're writing a specialized pre-approval that shows that that we, along with our finance partner, are willing to we will step in by contract and pay cash for this on time. if the buyer can't perform. So you get a specialized
When
letter.
their offer gets accepted, do they have to secure the program by paying $1,000 up front, I assume?
They paid at closing.
They paid at closing. Okay.
They paid at closing.
Yeah. Okay. So yeah, okay. So they pay it at closing. If they close on the loan, everything goes smooth. It's fine. They close, they pay the
They
thousand
just
dollars.
pay the fee. It's actually for the cash, simple cash offer scenario, it's $499. They pay the fee and that's it. We don't take possession. It just looks like a regular purchase transaction.
Okay, cool.
There are competitors out there that have a different model to do this, where they take possession every time. That is a more ponderous process and it's more expensive,
Okay.
because of transaction fees and there's higher risk levels. So we don't do it that way.
Okay.
So if you're not taking possession, like what's your safety net?
The safety net is, that's a good question. We can and will take possession. So let's say the buyer loses their job 3 days before closing and just can't close on time. We will step in and take possession. We'll pay cash. We'll close on time, and then we work it out with the buyer off to the side. So we'll try to get it closed with the buyer for 60 days after that.
So what happens if the buyer, for whatever reason, he's out of the picture and now you're stuck with the house?
So we'll turn around and sell the house.
Do you
Yeah.
use the buyer's agent as the listing agent?
Uh, this hasn't happened. This is relatively new and it hasn't happened to me yet. So good question. And I'll be honest, I don't know yet.
Okay.
They're banking on this not taking possession of properties. I had the same thought with Kevin. I'm like, okay, so they collect $1,000. If they do this 100 times, it's probably not even 100. It's probably more like 500 times that this happens. They have to close on one property. So now they've taken in 500,000 to mitigate any risk of any property they buy that may have not been worth that price. So it's almost like an insurance program. We all wonder,
Yes.
how does an insurance company make money when I've only paid $1,000 a year? Well, not 1,000. It's probably more like 2,000 a year. And my house burns down and they have to pay me $500,000. Well, it's the compounding amount of money that they're taking in. That's where their real profit comes in. So that to me is they're basically looking at MEP and saying, look, if you guys have underwritten this buyer, there's a 99.5% chance that this is going to close. And we're not going to have to step in.
Got it. Are you guys only in Massachusetts or Rhode Island as well?
We're in all of New England and about 15 other states. So, southeastern US, Florida, a couple Midwest states.
So you see, I put Kevin's information in the chat if anybody's looking for his information. Dickens, I see Dickens has a question. Dickens, you want to unmute yourself?
Yes, I was a bit confused. Kevin, if I got a buyer who go to your program and end up, their loan, they qualify for the loan. They don't end up using the cash buyer safety net, so they pay the fee, right?
Right. If they make the upfront offer with us,
Mhm.
to use Tracy's word, with the insurance policy, they're bound to pay the fee, the $499
Perfect. Okay.
at closing. Yes.
Perfect. Okay. And you say that you don't take possession of the house, so let's say that they use the cash buyer or the transaction works. So that's mean they close on the property. You just came as a lender. onto it?
So I'm not sure I understand the question. Are you questioning our role?
Yes, let's say that they use your what do you call for better word, your insurance policy. So they
Yes.
end up,
Yep.
use your insurance policy. On the transaction, they still buy it, and you end up become as a lender, right?
Yeah, we're the lender as
Yeah.
well. Yes.
Okay.
Yeah.
Okay, perfect.
A scenario, I think like there's a lot of scenarios I can see this working. I've in past talked to buyers about, well, put your deposit at risk. If you want to kind of give them a higher guarantee or stand out in a crowd of other offers, let's make our deposit fully at risk. This is a much better scenario than that. It's a $1,000 basically guarantee. If you're up against other offers and that seller is buying another property and there may be several transactions involved or home sale contingencies, I can see this being a real benefit of a program. It's reducing the risk to that seller, and if they've got an offer on another property, that might really help your offer stand out. If you talk to the listing agent, they're like, yeah, they've got another property already in agreement. They need to sell this fast. We need to perform, or they're going to kick us out. This is a great scenario. This is you know, let me show you an offer where, we're going to guarantee it gets to closing. And now you can stop worrying about this side falling apart. That's going to make this side fall apart. That's going to make this deal fall apart. You're reducing a risk point in a multiple deal scenario, and maybe only two deals. But as we all know, we've all been involved in deals where there might be four or five transactions involved in one, and if one domino falls, the rest of them fall. So giving one of those dominoes the opportunity to not fall at all is pretty strong. What are thoughts you guys have? And here's the other thing with this. I don't anticipate a ton of buyers would use this, but it's a conversation point. We're all looking for, what do we have in our tool belt that we can bring to the table or bring to the conversation that others haven't researched, don't know about, don't know how to explain. This is just another tool belt to say, like we're using it in some of our drip campaigns now of, if we could make you a cash buyer in today's market, even if you're getting financing, would that be of interest to you? We're getting replies to that. People want to know how they can stand out. They're tired of losing. Doesn't mean they're going to use it, not necessarily, but if it's something you brought to the table that another agent they're talking to didn't have or didn't know about, that it gives you the win.
Tracy, all of what we've discussed today is really centers around a competitive edge.
Mhm.
And a lot of it has to do with letting our clients, our buyer clients, know that they can get creative.
Yep.
And with competitive situations, if we continue to see enough transactions where we're presenting offers and there are multiple offers, then it's helping people to open their minds to being flexible and looking at advising them how to be competitive. And it really comes down, if they really want the property, as we've known in past years in strong sellers market, it's really comes down to win the bid if you've got competition. And Kevin's given us a lot of great ideas as far as how to take a unique approach to a recommendation of, here's some options that are available to you. And I'm curious, Kevin, what you're finding, because someone brought up the idea of, what if the property doesn't appraise? And we went through that fear in the past when, really strong sellers market and competitive, multiple offers and all of that. We did see, specifically, my question's going to be, we did see some trending where, and it probably was more in the upper price ranges, where became a common practice to offer to cover an appraisal gap.
Yeah.
And I'm curious to know what you and your colleagues, what what you're hearing, is that happening, and to what frequency compared to, I don't know, 3, 5 years ago?
Okay, is this are you talking about appraisal gap with the cash buyer program or just
Well, I'm just in general terms, are you seeing or hearing about the level of offer conditions and offers where buyers are offering an appraisal gap
Yep.
of cash payment, the way that we saw it, a few years back? I'm
Yep.
curious if are we competing with that the way we used to?
Yeah, I'm not sure. My business is really spread out. I have noticed that, dealing with the appraisal gap, the uh, the folks I work with, like you, the real estate agents, have gotten much more savvy about it. And I've noticed recently a kind of a new model emerging where everyone knows that the buyer's coming in high, might not appraise, and they're starting to work out language that basically says, we're okay if it doesn't appraise, but they put in a floor. So let's say they're offering 1 million and the listing price was 900. They might put in language in the agreement that says, as long as it praises at 875 or higher, so there's some kind of way to limit the damage. And then it's up to me, uh, off to the side, to work out with the buyer, what happens if it does under appraise above that floor and they have to go forward with the deal. And then, there are a number of things that we can do.
So if someone does the cash buyer program and it doesn't appraise, what happens?
So let me back up. And this is a kind of, I'm going to peel back the onion a little bit. Um, so because we are taking the risk of possibly having to buy this property, we do some valuation work in advance. And if the we if our work shows that the offer price is likely to be above the appraised value, we will require that the borrower put more earnest money down. So instead of 5%, we might say 5% plus an additional $10,000. And then if it goes to closing and it does appraise and there's no problem, obviously that's part of their earnest money deposit. They get the extra 10,000 back. If, however, something happens, the property doesn't appraise, we'll go, because we've done the valuation work, we go ahead and buy the property, even if it didn't appraise. But we will keep the earnest money. So that helps manage the risk on our end.
So going in before they're making an offer, you're running it, you kind of knowing this scenario up front, so that
Yep,
the buyer can decide if they want to try to employ that cash buyer strategy on that.
correct. So we might say, yes, you qualify for this cash buyer program, but you have to put an extra, $5,000 or $10,000 in as earnest money, just in case it doesn't appraise, and you don't, you can't go forward with the transaction, and we have to step in and buy. So it's a way for us to limit our risk.
Mhm.
So I
So,
think one of the good selling points for this program to a buyer, though, is usually a cash buyer doesn't necessarily have to be the highest offer. So, like, instead of them going way over, they're going to save money on the purchase price theoretically, as opposed to a financed offer. So in other words, that $500,000 house, instead of like us going 10 or 15,000 over asking, hoping to get the deal, if we're offering 500, which is asking price, but it's a cash deal, the seller might be more willing to go with us anyways, and you just save the buyer 15 grand.
Yes,
Yeah.
that's what we're counting on.
And in many scenarios, it's better than an appraisal gap coverage clause, in my opinion, because those are convoluted and, still brings the appraisal component into it. This is definitely a better scenario, I think, in some cases.
Kevin, I'd like to ask also, so just from the practical workings of this and structuring an offer, the terms of an offer, and as Stephen has said, it could by suggesting that it's a cash buyer, given that under the terms of that program that we've discussed, it could give the advantage to our buyer. And typically, what we find in return is we want evidence, proof of funds. And can you just touch on that? So we present, we have this cash buyer here. Okay, well, great that they're cash, but do they actually please demonstrate through proof of funds that they have that money to spend? How does that work?
Yeah, this is going to make it a different conversation because instead of proof of funds, you're going to say that there's a finance company um, willing to step in, or not willing, bound by contract to step in and do this.
And
Is there a
you'll have
letter
a
of
letter.
some kind you can provide?
Yeah, there'll be this will be part of the pre-approval letter. So there'll be a level of disclosure. That this isn't just a standard pre-approval letter that I might provide from, with my name on it from Mortgage Equity Partners. This is going to be a more expansive pre-approval letter that discloses that MEP and its finance partner are stepping in to provide the guarantee that we'll buy it for cash. So it's a different it's a different path.
So it's very clear. We don't launch something like that without knowing, dealing directly with you, having the conversation and coming up with a strategy collectively to make sure that all of those bases are covered. And that because we're reassuring, say, a listing agent of this is going to work. Here's the evidence, and assisting our colleagues in the industry because if they lack the confidence as a listing agent of how to go about presenting it, it's always helpful, I think, to even put in writing in the offer that the buyer authorizes the seller upon offer acceptance, the listing agent, the seller's agent, to talk directly with you, Kevin. So
Yeah.
put that in writing in our offer so that as reassurance, because we don't want the listing agent to shy away from it because they're uncertain or they just lack the skill to make the presentation to the seller. And a second thing that occurs to me is just as far as positioning and getting a competitive edge and helping our buyer clients, win the bid. Are you seeing many transactions where appraisal waivers are granted? And if so, what specific concerns might we want to have if we pursue that as a strategy of suggesting that, we will immediately upon offer acceptance apply for an appraisal waiver?
Right. So appraisal waivers are granted, and it's all case by case by software, Fannie Mae software or Freddie Mac software. They take all the borrower information, they tap their database, they'll have information about that property, maybe. It's got to be an owner occupied or second home purchase, not investment, not multi, and the price has to be under $1 million. And if the software likes what it's seeing, and it's a bit of a black box, you'll get two different types of appraisal waivers. The first type I like basically says we accept the value, no further work necessary. And by the way, I can run the software before the offer is even accepted. As long as I have a complete file that's accurate and I have the address and I have the final price, then we can find out if there will be an appraisal waiver. There's a second new type of appraisal waiver that I don't like. It says we accept the value, but you still need to send in an appraiser to check the condition of the property. I have never said yes to that kind of appraisal waiver because I feel like if the appraiser's going in knowing they don't have to do valuation work, they're going to find something wrong with the property. They're going to go looking for it. So I can imagine scenarios where I would accept that, but I wouldn't until I had a conversation. You know, if you were the buyer's agent, you would be part of that conversation along with the buyer.
So I mean, that, right, what you've said could make the difference between the offer being accepted or not. And that's,
I've won with that strategy. I've won with an appraisal.
yeah.
Yeah.
So, I mean, Kevin, that's like, it's a going into it, not waiting to, for mortgage processing to happen. It's a team effort with you,
Yep.
as far as building that strategy. And I know you're busy, but certainly, if we reach out to you and we've got this, and it's always, of course, the time pressure of got to get the offer in if there's competition.
Yep.
But we might, by providing you with the information that you just outlined that you would need in advance, it's possible that we could say that the property has been at least preliminarily evaluated and would most likely qualify for an appraisal waiver. And then, of course, as you've just done, and you could reiterate and share at the time of the occurrence, some scripting language where we can offer to that listing agent to elevate their confidence in presenting that as a tremendous benefit to their
Yep.
seller. I mean, because then the time savings of, we don't have to get 3 weeks. What's the average amount of time it takes to get an appraiser in from date of contract to ratification?
It's down to a week and a half now, but when we
Okay.
all get busy again, it'll be 3 weeks.
Okay. All
Yeah.
right. So anyway, that seems like just a prime thing to focus on as
Yeah.
far as.
Keep in mind, and this is again peeling back the onion, using appraisal or getting appraisal waivers and counting on them in advance is pretty tricky.
Right.
If let's say I get an appraisal waiver with an offer price of 905 through Fannie Mae's underwriting engine, but then the deal changes and it ends up being at 910. I don't have the appraisal waiver anymore. I can't if I the software has these built-in stops and I haven't quite figured out how to game it, but if the software thinks you're gaming the system, it'll pull the waiver and you never get it back. And I've had that happen to me. So there's a little bit of finesse required here.
So
So,
if I go to you, Kevin, and say we're thinking about going in at 900, we may have to use an escalation clause to 920. Are you submitting it as 920?
I would go in at 920.
Yeah.
Absolutely.
Yeah.
Because the software is okay if you start high and then go lower. But if you start low and go higher, I've had it just say, nope, that's it.
so maybe the safety is, as far as identifying this as a potential, is to say that upon offer acceptance, that the lender or the buyer will request that it immediately be submitted for an appraisal waiver,
Right. Or
contract acceptance.
we have one and we need to reconfirm it upon acceptance. Maybe there's
Okay.
something stronger there.
Okay.
Yeah.
I don't like that way as much. It just, to me as a listing agent, it's like, okay, whatever. Everyone's going to say that until they get it.
Yeah.
But on the other side, you could use it to, I would go on what your kind of max is. And if it's a situation where you're in an area of the market that's not flying and you're going under list price, because it does happen. I've got, in Worcester County, it's happening. I don't know if it's happening much in Middlesex County right now, but actually, no, I've seen it happen. I've seen some listings kind of hanging around there and you're going under list price. Go on, ask it at list price. And then if you're negotiating below it, that's just, more in favor of your buyer, but you're at least getting it at list price. You're asking for a waiver based on list price. Great strategies for sure. And as we wrap this up, any other questions before kind of what I wanted to share as a closing comment is it's great to have this knowledge. It's great that you guys are coming on this call. There's going to be other people that watch the recording afterwards. My suggestion is don't keep it like a total secret until the moment in time you need it is. Like put something out there. Hey, just got a great call with one of our lending partners today. If you think that if you think that being a cash buyer could help you in today's market, even if you're financing, or if you want to, get in at a rate in the fours for the first year, message me for more information. Use it as a conversation starter. If nobody knows you possess extra knowledge, then everyone's going to just think you're just another agent with a license, of which over 1 million last year didn't do a single transaction. I saw some numbers recently. I researched it a little bit. Of the 1.5 million realtors, and that's just realtors because there's over 3 million real estate agents. There's 1.5 million realtors. 70% didn't close a transaction in 2024. That's a lot. Now, a lot of those still have a license. They're still connected to people in their area, their friend group, their family group that may be buying or selling. And we're just going to go to those people unless they know that there's a better option out there. They know that, hey, there's this agent Lisa or George or Jeff that I keep seeing the stuff on, and they've got some specialized knowledge. They're sharing little tidbits of information. They're sharing all the information, whatever it is, whatever you decide to share. I'm a believer in sharing it all, but in some of your cases, you're like, I want to hold something back. Whatever it is, if it's little snippets or it's all the information, share what you know to your world and to your social media platforms, because it just might be the thing that makes Timmy's mother or father, who's friends with, a real estate agent's kid, decide, well, I was going to kind of go that direction because they're friends with my kid, but this person's sharing some knowledge that I don't know if that agent possesses, and that's something I could maybe use in my next real estate transaction. They may come to you. It's like we have to become specialists. Otherwise, it's like the same thing in the doctor world. I can get an appointment with my doctor, in no time. I could walk into any Reliant clinic anytime I want to. I could go see my doctor next week. But if I need a specialist, like I need a hernia surgery, I can't get into the specialist for like months. Like I was hoping to have this thing like done in the next 2 months. I'm looking at August, September now because you can't find a specialist. Like, and obviously we're in a whole different world, but the more you become a specialist, the better off you're going to be. Otherwise we're just going to keep losing deals to that agent that just kind of drives us nuts because I don't know, they're just a part-timer and they're not putting their effort into learning stuff like this. Yeah, whatever it is, they're just you're gonna continue to get driven nuts unless you kind of show your specialties and show that you're bringing more to the table than the average agent. Steve had his hand raised. Steve, you got a question?
Yeah, these programs that we just talked about, the cash buying opportunities, single family or also multifamilies?
Single family and condos, but not multifamilies at this time.
Got it. Okay.
Okay. Any other questions? Otherwise, we can end it. Yeah. Awesome. Great call, Kevin. What's your I did post in the chat your number, but why don't you spit out your phone number in case anybody wants to call you?
Sure. 617-827-0297.
So one more quick question, and it might be hard for you to answer this, but everybody wants to know, like who's got the best rates and fees. How would you compare yourself to other lenders like credit unions and local lenders, Washington Trust Bank, Coastal Credit Union, Navigate, so on?
For conforming loans and FHA loans, I have among the lowest rates. And honestly, the reason I have that is I pay myself less per loan than most of my competitors. So my strategy is to make it up by doing more
Fine.
work. Yep.
Awesome.
On jumbo loans, I'm kind of middle of the road.
All right. Thank you.
Good information. And I mean, as you can see, just by that question alone, the loan officers in this world are in the same battle as the real estate agents, which is a battle for what are people shopping you for? Are they shopping you just for rate, which is a terrible game to play and it just hurts and it doesn't feel very good? Or are you, educating yourself on programs like Kevin's educating himself on and bringing them to people like us to say, hey, here's some options that will help your clients win so that it doesn't become how low a commission will Lisa take or Jeff take or Maria take or how low a rate will Kevin offer. It'll become more of a they got me to my goal and they're bringing more knowledge to the table than it will be, how low can we get these people to go? Because
No,
it's not a fun game to
I
play.
agree. I agree, but I've had a few buyers where as soon as you get the offer accepted and now it's time for them to do the loan application, they're like, well, you know, your lender was great getting me the pre-approval and everything, but I think I can get a better rate over here. And I'm like, yeah, but I don't know those people. They're like, it's hard to get a hold of. It's like, I want a lender that I can communicate with during the transaction, not like a stone wall.
What's your thoughts on that, Kevin? I know that's probably
Music to my ears. Yeah. Um, I've had clients, walk away and they end up with, a national lender that only has a call center. And, good luck if something goes wrong or if you get a curveball. So,
Yeah, no, I hate that. But
yeah,
Kevin, thank you.
Yeah,
sure
we're all
thing.
going to continue to run into that for foreseeable future. I mean, I even see the days coming where people are offering a very low buyer agent fee just to, you go out and look at open houses, you see something you like, you pay me $1,000 to write up an offer. I mean, maybe not that low, I don't know. I'm just throwing out the extremes, but those services will always be out there. Um, I wouldn't say ignore them, be cognizant of them, try to get people to work with you based on your knowledge and your experience. And the same thing I'm sure Kevin does is like, you come to me for my knowledge and my experience, and I'll give you a good rate too, but hopefully you don't shop me out to the street. And you're going to lose something like that, and hopefully you win more than you lose. And as we've seen in the past, remember in 18 years, I've seen things like the flat fee listing service companies come and go. Guess who's kind of coming and going right now also is Redfin. Rocket is, it's yet to be told what Rocket is going to do with Redfin, but a lot of agents were running scared for a while, like, oh my God, they're offering all these discount programs for listing with them. And a lot of it was smoke and mirrors anyways. And then they didn't have the best agents in the street. There's a lot of reasons you could say that Redfin didn't go where they wanted to go with their company and then decided to sell it to Rocket Mortgage. Now Rocket's probably looking at it as an opportunity to say, look, we're going to go after the people that have gone with us for that rate shopping. We have the lowest fees, lowest rate because we don't have any infrastructure. They may be going after the same thing in the buyer agent side, but it's not going to, in my opinion, that it's not going to eliminate the real estate agent as it is. It may just highlight why people need a real, experienced agent that's doing this at a different level more than ever. I don't know. Time will tell, but just keep doing you and sharing your value with people, and some people will, some people won't.
Tracy, I have one last thing for Kevin, and because the whole idea of a competitive edge, and anytime we're working with buyers and they do need or prefer to obtain financing, what we all know is a letter of pre-qualification or pre-approval. It can be considered weak. So my question to you, Kevin, would be, isn't it wise for us to, with a committed buyer, to say, go ahead, commit to your lender and make the loan application, because if we have a conditional commitment rather than just a letter of pre-approval, then, my question then would be how long, upon formal application, how long would it take to get a conditional commitment on average?
So we can do that. Usually it's a 1 to 2 day turnaround. I have done it in the past. If the borrower is, W-2 income, base salary, no issues, again, that I might even be able to do that in less than a day.
So a statement of that, how would that be different from what, and again, when we're positioning a buyer to be competitive, how would that statement be different from the typical pre-approval letter?
So in my mind, it's better, but it can be worse. So it's a commitment letter issued by one of our underwriters, and it basically says, we've underwritten this borrower, and there are a couple of outstanding conditions: appraisal and title work, and we're going to re-verify some stuff right before closing, which is done on every loan. And I've had trouble with commitment letters in the past because I've been working with buyers or listing agents who don't understand what they are, and they see the formal language of an underwriter and they get scared, and they're like, no, I want the regular pre-approval letter instead. But if I'm, so the caution to you is, if since you're working with a savvy listing agent, absolutely, it works, but it can backfire. And there's a lot of conversation that has to happen. And usually I need to have a follow-up conversation directly with the listing agent to walk them through it.
And I think Jeff may have already asked, but does that conditional commitment letter have like an expiration date where, okay, you have to kind of like redo this every few weeks with the buyer?
Yeah, and actually that's another downside of the commitment letter. Pre-approval letter is pretty open-ended. I don't put expiration dates on mine. However, with a commitment letter, underwriters do have to put expirations on it, and it's usually going to be 60 to 90 days out. So income documents start to expire 60 days out.
Got it. Okay.
Good question.
Awesome. Any other questions? I'm going to stop the recording here just so it's hard to convert one.